Gold just lost over $1,000 in less than a week. Not slowly, not gradually. $1,000 gone, evaporated, and it is still falling as I record this. Silver is even worse, down 32% from its record high. Just days ago, 32%. If you had $100,000 in silver last week, you have $68,000 now. $32,000 vanished in days. This is not a pullback. This is not profit taking. This is the worst precious metals crash in over 4 decades. The worst since 1983. And I am going to show you exactly what caused it, who is behind it, and what happens next. Because what you are seeing on your screen right now, these red numbers, these crashing charts, this is not random. This is not an accident. This was triggered. And the trigger had a name. Welcome back to the channel. I am Mr. AG, and if you are new here, this is where I break down what is really happening in markets while everyone else is reading headlines. Subscribe right now and hit that notification bell, because when markets move like this, you need to know immediately. And if this video helps you understand what is happening, smash that like button. It pushes this video to more people who need to see it. Now let us get into it. Friday, January 31st, 2026. Gold records its sharpest single-day drop since 1983. Over 9% gone in one session. $900 wiped off the price. Silver collapses 27% in the same session. 27%. The kind of move that destroys portfolios, triggers margin calls, and sends traders into panic. But that was supposed to be the worst of it. Everyone thought the selling was done. Everyone thought the bottom was in. Everyone was wrong. February 2nd, markets open in Asia. And it gets worse. Gold plunges another 10%. Silver drops another 15%. As I am recording this, gold briefly broke below $45,100 per ounce. Down from $5,594 just 5 days ago. That is $1,094 gone in less than a week. Silver went from a record high of $121 to under $83. Think about that. Think about what that means for anyone who bought at the top. Think about the margin calls. Think about the liquidations happening right now, this minute, as you watch this video. So what triggered this? What caused the worst precious metals crash in 40 years? The mainstream media will tell you it was Kevin Warsh. They will say Trump nominated Warsh as the next Federal Reserve Chair, and markets reacted. And technically that is true. But that is like saying a building collapsed because someone lit a match. The match was the trigger. But the building was rigged to blow. Let me show you what I mean. Kevin Warsh, former Fed governor, known as a hawk on monetary policy, known for wanting to shrink the Fed's balance sheet, known for keeping interest rates higher to fight inflation. Trump nominates him on a Thursday evening. By Friday, gold is down 9%, silver down 27%, the dollar jumps 1%. Markets interpret this as the Fed staying hawkish, higher rates for longer, less money printing, bad for precious metals. That is the surface explanation. That is what CNBC tells you. That is what Bloomberg writes in their headlines. Fed chair nomination causes gold sell-off. Simple, clean, easy to understand, and completely missing the real story. Here is what they are not telling you. The same week as the Warsh nomination, CME Group announced increased margin requirements on precious metals futures. The same week, not a month before, not randomly. The same week as the announcement that they knew would trigger selling. When you trade futures, you put down a margin, usually around 10% of the position size. CME announced higher margin requirements to take effect after Monday's close, right after the Warsh announcement, right as traders were already panicking, right as selling pressure was already building. They added fuel to a fire that they knew was starting. And I want you to think about why they would do that. Think about who benefits when long positions get liquidated. Think about who is on the other side of those trades, the big banks, the institutions with massive short positions. Every dollar gold drops, they make millions. Every margin call that forces a retail trader to sell, they profit. Deutsche Bank analysts said it clearly. The clear catalyst for Friday's sell-off appeared to be news that Kevin Warsh had secured the nomination for Fed chair. But they did not mention the margin hikes. They did not connect those dots. That is what I am here to do. Now let me show you the global carnage. Because this was not just about gold and silver. This was a financial earthquake that cracked markets across the planet. South Korea. The Kospi index fell 5% in a single session. That is a crash by any definition. The Korean won plunged against the dollar. And here is the part that really got me. Gold traded on the Korea exchange fell to its lowest permissible limit, down 10%, circuit breakers hit. The first time that has happened since they opened that market in 2014. First time ever. Traders in Korea could not sell. The market would not let them. They watched their positions bleed out and could not do anything about it. Sound familiar? Sound like what happened to silver traders in China last week? Platforms freezing, orders rejected, exits blocked. This is not a coincidence. This is a pattern. Hong Kong, Hang Seng dropped 2%. Japan, Nikkei down over 1%. London. The FTSE initially crashed before recovering. Even U.S. equities felt the shockwave. S&P 500 opened lower. Nasdaq dropped 0.3%. The Dow managed to eke out a small gain, but only after the bleeding stopped. Oil crashed nearly 5%. Brent crude fell to $65. WTI dropped to $61. The entire commodity complex was under assault. Gold, silver, oil, all crashing at the same time while the dollar spiked. This was not normal market behavior. This was coordinated pressure, a global liquidation event that hit every market simultaneously. And who was buying while everyone else was panicking? That is the question you should be asking. When retail traders are getting their faces ripped off, when margin calls are cascading through the system, when platforms are freezing and circuit breakers are triggering, someone is on the other side of those trades. Someone is accumulating at these prices. And it is not regular people like you and me. It is institutions. It is central banks. It is the same entities that have been buying gold all year while telling everyone else it is too expensive. The World Gold Council reported that gold is still up 70% from the same time last year. Even after this crash, even after losing $1,000, 70% higher than 12 months ago. That tells you something about the demand that exists for this metal. That tells you this crash is not about fundamentals. The fundamentals have not changed. Central banks are still buying. Geopolitical tensions are still elevated. The national debt is still exploding. Nothing has changed except the paper price. And paper can be manipulated. Physical cannot. Here is what the analysts are saying. And pay attention to this because even the mainstream voices are not calling this a trend reversal. Michael Hsue, precious metals analyst at Deutsche Bank, said the conditions do not appear primed for a sustained reversal in gold prices. He said investor demand for upside remains strong. He said volatility is more likely than a collapse in sentiment. Deutsche Bank is still forecasting gold at $6,000 by the end of 2026, even after this crash. Even after the worst week in 40 years, they still see gold going higher. Grace Peters, global investment strategist at JP Morgan Private Bank, went on CNBC and reaffirmed her bullish outlook. She said gold is the best geopolitical hedge. She maintained a forecast of $6,500 per ounce by end of year. That is almost 40% higher than where we are now. JP Morgan is not panicking. They are buying. Nitesh Shah from Wisdom Tree called this a healthy correction. A healthy correction. He expects gold to reach $5,020 and silver to hit $88 by year end. The smart money is not running away. They are positioning for what comes next. But here's the problem. Most retail traders will not survive to see what comes next. Most retail traders got shaken out last Friday. Most retail traders saw their accounts blow up, their positions liquidated, their life savings disappear. And that is by design. That is how this game works. They crash the price to flush out weak hands. They trigger margin calls to force selling. They buy what retail was forced to sell. Then they let the price recover. Wealth does not disappear in crashes like this. It transfers. It moves from one set of hands to another, from your hands to their hands. The question is whether you are going to let that happen, whether you sized your position correctly, whether you had stops in place, whether you were trading with money you could not afford to lose. Now let me explain what happens next, because understanding the mechanics of this crash is crucial for knowing where we go from here. The Warsh nomination changes the calculus for the Federal Reserve. Warsh is known as a hawk. He wants to keep rates higher. He wants to shrink the Fed's balance sheet. He wants to fight inflation, even if it means pain for markets. This is the opposite of what precious metals bulls want. Gold and silver thrive when rates are low, when money is being printed, when real yields are negative. If Warsh keeps rates high and strengthens the dollar, that is a headwind for metals. That is why the market reacted so violently. But here is what the market might be missing. Trump did not nominate Warsh because he wants high rates forever. Trump has been calling for rate cuts for years. Trump wants a weaker dollar. Trump wants cheap money to juice the economy. So why nominate a hawk? Because Trump is playing a longer game. Warsh does not take over until Powell's term ends. There is time for the current Fed to cut. There's time for the economic situation to change. Trump might be positioning Warsh as a tough negotiator, someone who can stand up to foreign central banks, someone who can project strength. But the actual policy might be different from the rhetoric. The market is pricing in hawkish policy based on Warsh's history, but Trump's track record suggests he will push for dovish policy regardless of who is chair. This disconnect creates opportunity. The market might be wrong about what Warsh will actually do. The crash might be overdone. And there is another factor that nobody's talking about. The Federal Reserve's independence is under question. Charles Henry Monchot, chief investment officer at CIS Group, said there's a question mark about Powell staying on the board. He said there are a lot of uncertainties and the market does not like uncertainties. If Powell leaves early, if the Fed's independence is compromised, if Trump starts directly influencing monetary policy. That is bullish for gold. That is exactly the kind of scenario that drives people into hard assets. The market is selling gold because of Warsh's hawkish reputation. But the bigger picture suggests more chaos, more uncertainty, more reasons to own gold. The crash might be giving us an opportunity that does not come around often. Let me talk about what to watch from here. These are the signals that will tell you whether the bottom is in or whether more pain is coming. First, watch the dollar. The dollar spiked on the Warsh news, up 1% in a single session. If the dollar continues to strengthen, that is a headwind for gold. Gold is priced in dollars. When the dollar goes up, gold effectively becomes more expensive for foreign buyers. That reduces demand. But the dollar has actually been weakening most of this year, down over 9% in 2025, down another 1.2% so far in 2026 before this week is spike. If the dollar spike was a one-time reaction to the Warsh news and it resumes its downtrend, gold will recover. Watch the dollar index. That tells you a lot about where gold is heading. Second, watch the bond market. Yields spiked during this sell-off. Higher yields mean higher opportunity cost for holding gold. Gold does not pay interest. When bonds are paying 5%, holding gold looks less attractive. But if yields start falling again, if the Fed signals cuts are coming despite Warsh, gold becomes more attractive again. The bond market and gold often move inversely. Watch the 10-year Treasury yield. Third, watch central bank buying. This is the fundamental support for gold. Central banks have been accumulating gold at a record pace. China, Russia, India, Turkey. They are all adding to reserves. They are diversifying away from dollars. If this buying continues through the crash, that tells you the floor is solid. Central banks are not panic selling. They are buying dips. Follow the smart money. Fourth, watch the physical market. During last week's crash, there were reports of massive premiums in physical markets. Dubai saw premiums spike to 15% over spot. That means physical buyers were paying 15% more than the paper price just to get actual metal. When paper crashes, but physical holds, that tells you the paper price is artificial. The real demand is still there. Watch the premium between paper and physical. If it stays elevated, the paper crash is not reflecting reality. Fifth, watch the margin requirements. CME raised margins during this crash. If they raise them again, more forced liquidation is coming, more pain ahead. But if they stabilize or reduce margins, that signals the worst might be over. The exchanges control the pressure valve. Watch what they do next. Now let me talk about what this crash means for you. If you're watching this video, you're probably invested in precious metals or thinking about it. You probably saw your portfolio get crushed last week. You might be wondering whether to sell, whether to buy more, whether to just walk away and never look at gold again. I cannot tell you what to do. I am not your financial advisor. But I can tell you how to think about it. First question, were you overexposed? Did you have too much of your portfolio in precious metals? Did you use leverage? Did you buy options or futures without understanding the margin risk? If yes, this crash taught you an expensive lesson. Position sizing matters more than price prediction. You can be right about the direction and still lose everything if you are sized wrong. The traders who got wiped out last week were not wrong about gold. Gold is still up 70% year over year. They were wrong about their position size. They could not survive the volatility. Second question, has anything fundamental changed? Is the national debt smaller? Are central banks selling gold? Has inflation been defeated? Is there more trust in fiat currency? If your answer to all those questions is no, then the reasons you bought gold in the first place are still valid. The crash changed the price. It did not change the fundamentals. Paper prices can be pushed around in the short term, but over the long term, fundamentals win. Third question, can you survive until clarity? That is the most important question. Do you have the financial stability to hold through more volatility? Because there might be more volatility coming. The market is not stable right now. Warsh has not even started yet. Powell is still making decisions. The transition will be messy. If you need the money next month, you should not have it in volatile assets. If you can wait years, volatility is opportunity. Let me tell you a story. During every major gold correction in history, there were people who sold at the bottom. People who could not take the pain anymore. People who convinced themselves that this time was different, that gold was going to zero, that they had made a terrible mistake. In 2008, gold dropped from 1,000 to 700 during the financial crisis. People panicked and sold. By 2011, gold was at 1,900, a 170% gain from the panic lows. In 2013, gold dropped from 1,800 to 1,200, a 33% crash. People said gold was dead. By 2020, gold was at 2,000. Those who held through the pain were rewarded. Those who sold at the bottom missed the recovery. I am not saying this is the bottom. I'm not saying gold goes straight up from here. Nobody knows where the exact bottom is. But I am saying that the pattern repeats. Panic selling leads to regret. Patience leads to profit. The institutions know this. That is why they are buying while retail is selling. That is why JP Morgan is forecasting 6,500 while their clients are panicking. They have seen this movie before. Let me give you the numbers that matter right now. Gold at approximately 4,725 as I record this. Deutsche Bank, $6,000 gold by end of year. JP Morgan, $6,500 gold by end of year. Wisdom Tree, $5,020 gold and $88 silver by end of year. These are major institutions making public forecasts after seeing the crash. They are not downgrading their targets. They are reaffirming them. Ask yourself why. Ask yourself what they know that you might be missing. The fundamentals. Let me repeat them. Only 216,265 tons of gold have ever been mined in human history. That is all that exists. It cannot be printed. It cannot be created by central banks. It cannot be inflated away. When governments print trillions of dollars, when debt spirals out of control, when fiat currencies lose purchasing power, gold holds value. That has been true for 5,000 years. One crash does not change that. Central banks know this. That is why they are buying at a record pace. China added more gold to its reserves last year than any country in history. Russia has been accumulating for a decade. India just bought another massive chunk. Turkey keeps adding. These are not dumb investors. These are sophisticated institutions with teams of analysts and decades of experience. They are not selling into this crash. They are buying it. So here's my take. This crash was manufactured. It was triggered by a combination of the Warsh nomination and coordinated margin hikes. It was designed to shake out long positions before the real move higher. The institutions that profit from lower prices are the same institutions that influence exchange policy. The timing was not a coincidence. The margin hikes were not random, but manufactured crashes do not change fundamentals. They create opportunities. The wealth that moved from retail to institutions last week will move back when the trend resumes. The question is whether you will be positioned to benefit or whether you got flushed out. Track the signals I mentioned: dollar index, bond yields, central bank buying, physical premiums, margin requirements. These tell you what happens next. Do not react emotionally. React strategically. Do not let them shake you out if your thesis is still valid. And if you were overexposed, if you were using too much leverage, if you got hurt, learn the lesson and come back smarter. Drop your thoughts in the comments below. Tell me if you bought this dip or if you're waiting. Tell me what you think about the Warsh nomination. Share this video with someone who is panicking right now and needs to see the full picture. Subscribe if you want more analysis like this. I am covering this situation daily until we get clarity. The next few weeks are going to be volatile. You need to stay informed. This is Mr. AG. The crash was painful. The fundamentals are unchanged. Physical wins. It always does. The only question is whether you survive until it does. See you in the next one.